This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you're listening to episode 39. I just wanted to take a moment to let you know that I take great pride in bringing you the best content possible covering the microcap universe. No pun intended. So if you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@SNN.Network. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with Paul Andreola, editor, and Brandon Mackie, writer-researcher at Small Cap Discoveries. I'm very excited that Paul and Brandon will be speaking at our annual event, the Planet MicroCap Showcase, April 26th through 28th, 2017, at the Planet Hollywood Resort and Casino in Las Vegas, Nevada. They have a very unique microcap investing perspective, which we discuss at length in this interview, especially with regard to their core investing strategy and process when looking at Canadian microcap stocks. I also spoke with them about the panels they will be speaking on at the Planet MicroCap Showcase, discuss at length the history, investing landscape, and infrastructure in Canada, as well as accessibility for U.S. investors to invest in Canadian listings and their assessment of the Canadian investing climate currently. The goal for this episode is to learn more about Brandon and Paul's strategies when looking at Canadian microcap stocks, how they find new ideas, and their thoughts on the current Canadian investing market. Thank you again for tuning in to episode 39 of the Planet MicroCap Podcast. Please enjoy my interview with Paul Andreola and Brandon Mackie, but first, a word from our sponsor. Hey everybody, Robert Kraft here, your host on the Planet MicroCap Podcast. I'd like to take this moment to invite you to join me and some of the guests you may have heard on this podcast to our annual MicroCap Investor Conference, the Planet MicroCap Showcase, April 26th through April 28th, 2017 at none other than the Planet Hollywood Resort and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you'll get to meet privately in one-on-one meetings with company management of undiscovered and well-known microcap companies. There are a lot of surprises in store, and you're not going to want to miss it. So join us at the Planet MicroCap Showcase, April 26th through April 28th at the Planet Hollywood Resort and Casino in Las Vegas. For more information, go to www.planetmicrocapshowcase.com and register now to reserve your spot. See you in Vegas. For this episode of the Planet MicroCap Podcast, I have Paul Andreola and Brandon Mackie on the program. Paul is the editor and Brandon is the writer-researcher at Small Cap Discoveries. Paul and Brandon, welcome to the Planet MicroCap Podcast.
Hi, Robert. Thanks for having us on. Good to be here.
It's great to have you on the program. So, Brandon, this is now your second time on the podcast, and Paul, this is your first. So I would say welcome, and Brandon, welcome back. Thank you again for joining me. And to start, for those who missed our first interview, Brandon, and for those who may have missed our video interview, Paul, which we did not too long ago, what are your backgrounds and how did you get started investing in microcap stocks? Paul, let's start with you.
Sure. So I've been at this microcap business for about 25 years. I started with 10 of those years as a stockbroker, focusing specifically on microcaps and Canadian microcaps. Once I left the brokerage business, I actually was involved in 3 different technology startups, 2 of which did quite well and one which failed, which I think I've learned probably more from the one that failed than the other 2 that did well. And then, also along that way, money at work there and learning as I go.
And Brandon, how did you what is your background and how did you get started?
Yeah, sure. So I have a bit of an unusual background. I'm a chemical engineer by training. Got started in the oil and gas business as a facilities engineer about 2011. So I've been at it about 6 years, and starting out as an engineer, I just happened to be reading, came across Warren Buffett's early writings, some of Ben Graham, the foundational of value investing, and as a lot of people's stories go, I got hooked. Kept reading, which led me to various blogs, and started to try and put some of my savings to work investing. And after having some mixed success with that, I decided to start my own blog, really as a way to just get my ideas out there, get some feedback, hopefully meet some people in the industry. So I started a blog about a year later, 2012. That blog was called Motology, and the philosophy there was to take Warren Buffett's idea of moats and companies with competitive advantages, but instead of talking about, Apple or Google or some of these giant companies, take it to the small cap world. And so that's what I tried to do, and through that, built up a following, a network. That's how I met Paul through the blog. And somewhere along the way, I wrote about a company that a local hedge fund in Houston was currently undertaking an activist campaign. They found my blog post, got in touch with them, and that ultimately led to a job offer, which kind of got me into the finance industry. There for a bit, started the newsletter with Paul, and then had an opportunity to go work at a startup out in California, so that's what I do now. But continue to invest my own money and stay up with the microcap world.
Well, it has been nice having you as a neighbor, I must say. And
yeah, I go surfing more though.
That is, yes, most definitely. If only it stopped raining. Thankfully, it did today. But, I wanted to follow up with you, Brandon, real quick, because my next question had to do with, when and why you both started looking at Canadian microcap stocks in particular, because you said you started this blog, Motology, and you decided then you wanted to apply that theory to small caps. What made you decide to do that?
Yeah, so it was kind of a natural progression where, I started with the really big companies, and I was looking for kind of distressed situations where bad news would come out, and, things like Herbalife, which I owned at one point, don't own currently. But I kind of came across some blogs that were just talking about how the return potential is so much greater in small and micro caps because the large market, large hedge funds, institutions, they can't really invest in microcaps. It's not enough to move the needle, and in some cases, they're not even allowed by their bylaws to invest in them. So that got me really interested to think that, as a young investor, not having a lot of experience, the deck was kind of stacked in my favor, and I could have more opportunity for success. And so I came across a newsletter through a site called Guru Focus that was highlighting a lot of these companies. A lot of them were U.S., and had some really great success in a few of those companies, and that got me kind of hooked, and ultimately got me kind of sold on the micro and small cap arena. Mm-hmm. Now, in particular, how did I land in Canada? That was kind of by accident. I started out looking all throughout the world. I was investing in companies in Sweden, in the UK, Australia, anywhere that I could find, a company with competitive advantages that was small, growing, and at a cheap price. And that fourth point is really the key, because there's plenty of those in the U.S., or at least in 2013, but many of them had sky-high valuations. And so through that criteria, I just kept finding one after another in Canada. And so the next thing I know, I look at my portfolio, and it's almost all Canadian companies. And I think there's an interesting reason for why that is that I'm sure we'll get into later in the podcast, but it's really by accident that I landed Canada and decided to devote myself completely to the space, about a year later.
Mm-hmm. And Paul, when and why did you start also looking at Canadian microcaps? And then, I don't know if you can speak for you and Brandon, but is there a specific sector or sectors that you particularly focus on? And by the way, I'm assuming that you didn't just get into Canadian microcaps because you're Canadian.
Well, no, but it helped. I think Yeah, what I was finding is because most of as a broker, most of my clients are Canadian. They were looking for Canadian ideas, but that didn't preclude me from bringing U.S. ideas to the clients as well. But what similar to what Brandon was finding was we were finding that the valuations were better in Canada, and I think to date we still do find that to be the case. It's easier for us to do due diligence in Canada because I know the systems up here, and I think just the mere fact that we're finding the right kind of companies that were fitting our criteria with the right valuations, it kept us here. So, yeah, that's I'd say the bulk of the reasons why we're still up here in Canada.
Mm-hmm. And is there a particular sector? Well, you know what? I'll re-ask that question as it pertains to my next question, because for those who may not know, what exactly is the Small Cap Discoveries newsletter, and does it focus on a particular sector or not? And Paul, if you could answer that one.
Sure. So it's easier to actually say what we don't focus on. So we don't do anything in the resource sector or resource extraction sectors, and we also don't do anything sort of in the financial arena. We tend to look for businesses that have some form of repeatability. So if you're selling a piece of software, if you're selling a widget, if you're selling something, it's easy to repeat that. Whereas in the resource sector, you find a deposit. Well, at the end of that deposit, it's more or less gone. So where we're finding our most success, we're in the biotech space, we're in the software space, industrials, and most of the companies we actually look at tend to be in niche markets, which we can certainly get into why we think that makes for better investments. But we're a little agnostic, so we'll look at almost any sector that meets our criteria from the bottom up.
Mm-hmm. Brandon, do you have anything to add to that?
Yeah, sure. So, I think at a high level, what we're trying to do is find Canada's best emerging growth companies. And so people, try and put that into a certain style of investing. I think one that comes up a lot is growth at a reasonable price, which is, GARP investing. Mm-hmm. I would take that a step further and say we're really looking for growth at an unreasonable price, unreasonable being unreasonably low. We really want to find something that's very early on in the discovery process, so really no one knows about it. Things are just starting to move in the right direction, and we're starting to see the signs of what could make for the next growth darling of the future, and it's right at that moment that we're trying to invest. So it's a very kind of fine line between companies that are too early and haven't proven out their business, and then catching them before the mainstream media and a lot of the other institutions. And that's what we're really trying to do, is get them early on in the discovery process, because we believe that the discovery process will drive prices and valuations higher than even business performance.
Mm-hmm. So I guess you're going to patent the Gow-Earn process, right? Am I right?
Not a bad idea.
So, my next question then, it has to do specifically with, the strategy that you do employ. And you've mentioned this, you've kind of alluded to it a little bit already, but, what is the core investing strategy when assessing a potential new investment? And then also, how do you find these new potential or these new ideas that you're going to look at? I'd say, Brandon, you want to start this one off, and then Paul follow up?
Sure. Yeah. So building on what I alluded to in the last question, this idea of the discovery process, and this is something that we've done some presentations out at different conferences over the past year, and we've really been building on it since we started the newsletter. And the discovery process is this idea that every stock starts out very early on. Whether it's a large company that falls from graces or a completely new emerging company, starts out at a point where really nobody knows what it is, and there's very little trading volume, very little things happening, and maybe there's legacy shareholders that are stuck in it that kind of forget about it. And then something starts to work, whether a new management team gets in, a new product starts to really resonate in the marketplace, and it starts to show up in the financials, and growth starts to happen. It's really in that moment that we're trying to identify companies that are hitting an inflection point, which we characterize as 2 quarters of 25% or more revenue growth year over year, and 2 quarters of profitability. And it doesn't have to be huge profitability, but positive net income. And a lot of times what happens is the share price will start to respond, and a lot of those early shareholders or people in it will see it as an opportunity to head for the exits because they've been holding this thing for years. And we find that that's a really attractive point to get into and get positioned, assuming that the momentum of the company continues to go. So that's kind of the basic framework. Now, how we find those companies, I'll let Paul talk some more about that. It's a combination of a manual process and also, people in the industry sharing ideas, newsletters, blogs, all sorts of sources. Paul, you want to build on that?
Well, real quick, Paul, I just wanted to follow up real quick, Brandon, I want to know the difference then between what you deem as the discovery process, but then also timing. What's the difference between this idea of discovery and I'll coin the phrase discovery investing versus, let's say, a time-sensitive investing, so to speak?
Well, yeah, really, what you're looking for is just these certain catalysts, which sometimes are time-based, sometimes aren't. A company can go many, many years being completely undiscovered, and they can have one positive event, and they can go from undiscovered to discovered, in a matter of days. We had one company on our watch list that we never owned, Accelaware, that went up, I think it was 1,300% in a single day, because they announced a large contract with GE. So sometimes these things can happen very fast. Sometimes they can happen very slow. We're trying to find opportunities that evolve, over a period of, say I call it a couple weeks to a year. It's kind of the ideal time horizon to see these things play out. Versus, holding something for 10 years or trying to do short-term trading. It's kind of that balance right in between. And we tend to think less time-based and more catalyst and what are the data points and what are the financials telling us. And as long as things are continuing to move in the right direction, we're likely going to be shareholders first, deciding we'll sell after it goes up 50% or we'll sell after 3 months. That's not really something that feeds into our framework.
So Paul, then thank you for that, because that does actually then lead into, what I think Paul is about to elaborate on is, how do you guys find new ideas then?
So we rarely look at ideas that come to us. We want to be out there looking for them before everybody else finds them. And the way we do it is similar to what you guys have down in the U.S. in EDGAR filings. We have what's called CDR filings up here in Canada. So on a daily basis, we will go through all the financial reports that come out, on the Canadian public companies. And they're, in earnings season, you're going to get a lot of companies filing all at the same time. And sometimes, some days, there won't be as many filings. But we'll go through every single filing of all the companies in Canada to look for those ones that sort of meet our basic criteria of that 25% or more growth that Brandon was mentioning. And then once we find something that meets, the revenue growth and profit criteria we look for, we'll take it aside, and then the real work starts. And we'll look at everything from, their margins. Are the margins going up or down? What kind of insider ownership is there? We go through all our contacts within the industry up here, and we'll look for, try to get a reputational assessment of management or directors. And there literally is a pretty extensive list of things that we go through, but it fine-tunes what we're looking for. And, ideally, if we can find 5 or 6 good ideas a year, we're happy. And we're not looking for deals that are just good. We're looking for great deals. So, and we're trying to find the best 5 to 10 deals out there rather than just try to find good deals. So Paul, it's a fair bit of work, but it works out quite well.
So Paul, like in this process, it sounds like quite the undertaking. Do you guys have a program in place, or do you do it all by hand, human? Looking at the filings and say, okay, yeah, you do.
Yeah, it's all human. It's all because there's a lot of screening softwares you can use to do what we're talking about doing here. But the problem is every now and then one or two will fall through the cracks and not make it onto that screening software. And those are typically the ones that are the most valuable because there's even less people that are able to access that information. So we're prepared to roll up the sleeves and take pen to paper and try to literally manually go through every single filing there is, so that we don't miss the odd one that we don't want to miss.
Mm-hmm. And then, as another follow up to that, I mean, what's your thought then on watch lists? Because if I could single out one bit of your criteria where you say you're looking for 2 consecutive quarters of growth, of profitability and profitability growth, if you notice that a company has it was their first quarter of being profitable, or let's say it was their first quarter of finally breaking even, do you put that on a watch list somewhere and then follow it up and set an alert or something? How do you do that?
Literally, you sort of you nailed it. We've got a watch list of probably about 100 companies that, to some degree, have met most of the criteria, but not all the criteria. And we will keep those on watch. We'll keep looking and keep watching for any events that will trigger sort of the last criteria that we're looking for. But most of the work really comes from the financial statements. So when a company is meeting 9 out of the 10 criteria, for example, we still want to see, and quite likely that 10th is going to show up in their next set of filings if they're ever going to get there. So the filings are really where we do most of our early work. Mm-hmm. And like I said, if it's close, we'll keep watching it until it either falls right off the list or falls onto the list.
And what's like the range of the growth rate that you're looking for quarter over quarter to make it somewhat more interesting for you guys to look at?
Brandon, you want to take that one?
Yeah, sure. So I think, at the bare minimum, we'd like to see double-digit revenue growth year over year. Mm-hmm. With a couple of our companies that have high gross margins, that do a good job controlling expenses, which you can get a lot of times, is really high operating leverage. So while revenue growth might be 10% year over year, earnings growth could be 50% year over year. Mm-hmm. And while that's happening, and if you have an expanding PDE ratio, then you can get some really good returns that way. Mm-hmm. So those do happen, but our ideal situation is where you have revenue growth that is 25%. We like to see, we've invested in a couple companies that have had 50% mm-hmm. year-over-year growth rates. And in our experience, that's kind of a magic number where if a company can sustain that for a couple years, and they have high gross margins and operating leverage, then you can really get to some pretty spectacular returns. And mm-hmm. it's very difficult to find companies that can maintain a growth rate of 50% mm-hmm. every year, but for those few that you can, those, when we look back at our some of our winners over the past 5 years, I think that's a number you continuously find time and time again. Mm-hmm. But there's even some companies like Light Access Technologies, which is one that we own, where the revenue growth was over 1,000% year over year. And that's very unusual, but sometimes the right macro trends are happening, the right industry dynamics are in place, and you can see that. So there's really no upper bound into what we would look for in terms of revenue growth. Mm-hmm. We just don't want to pay too much for something for that growth. But if we can get it at a reasonable price or an unreasonable price, then we start to get really excited about future profit potential.
So one more follow up on that, like using Light Access as an example. If you happen to see that 1,000% growth year over year, what happens when, let's say, a company does? I mean, that's not. I mean, it may be sustainable for some businesses, but I just, that eventually doesn't, that's just not a sustainable number, a company growing 1,000% year over year. So at what point do you then measure that success in the sense that, when do you start to make it, like what type of numbers do you look at so that you can understand like a more realistic year over year growth that you think it probably will go to that will still keep the company interesting to you guys? If that makes sense.
Yeah, I would say back to kind of that 25 to 50% growth range, which is something that we would look towards. I mean, a lot of times when we're looking at these, management may be telling us, hey, we can do 50% year over year, but we'll do all our analysis and base our valuations off of, let's say, 10%. And we'll look at it and we'll say, well, if it only grows 10%, if earnings only go to this, what does the valuation look like? Are we still going to potentially make money on this deal, or do we need to hit 50% growth, or the stock's going to fall off a cliff? So really, you can't just look at revenue growth or earnings growth in isolation. Everything has to be looked at relative to the price and what you're paying for it. And so it's the kind of, heads we win, tails we don't lose a lot. That's what we're really looking towards, because you're right. I mean, you see growth rates of 100%, 200%. You can't base a valuation on that, only in very rare cases, because naturally the numbers get larger, competition comes into the marketplace. Everything works to kind of bring that number down over time, and that's what you would typically see is decelerating revenue growth rates as the company gets larger.
So Paul, I Brandon, I interviewed Mike Schellinger a little earlier this year, and one thing that we discussed was we discussed the Canadian MicroCap market quite a bit, and at Small Cap Discoveries, you covered this segment primarily, and it's in my opinion, it's been gaining more visibility. So Paul, I'll throw this one to you. Why do you think that is?
I actually think there's a handful of reasons. One is the market's obviously smaller here, so there's less, I'll say, competitors on when looking at deals. But I think the bigger reason for the valuations in Canada is that actually I think the system itself is broken in Canada. The market, or the sort of investor market, brokers, institutions, things like that. For one, Canada's got a level fair with resources, so it tends to be a little bit more resource focused. But secondly, most of the analyst reports, most of the sort of sector interest is where there's opportunities for financing. And if a company's doing well and making money, then there's very little chance for financing opportunities, and hence the brokerage sort of industry can't generate commissions. So a lot of these small companies that actually start being successful become orphans. There's nobody out there, putting out research reports and sort of bringing attention to these little companies who are hard at work. I think the U.S. system is a little bit different, where there's a lot more players there that have a vested interest in seeing some of these great little companies get fully valued. So, it's interesting that a lot of the Canadian companies here, that once they start to get some success and once they start actually rapidly building their business, a lot of them are interested in going down to the U.S. to get a better sort of a more market attention and hence better valuation. So I think the U.S. market's always been looked at as a bit of the big leagues, and a lot of the small caps here, because they don't get quite the same sort of valuations, ultimately want to go down there. And like I said, because of the broken system and a few other factors, I think they just better. We call it mispricing. There's more mispricing in the Canadian market than we're seeing in most other markets.
Would you say it's a recent phenomenon, or is this something it's been noticeable for a while, and finally now a lot of the companies, like for instance that you guys follow, are starting to get more of a following in the U.S. So I guess has it been more recent, or has this been going on for a long time?
Well, I've been at this for about 25 years, and it's always, to some degree, been like this. I think now because of the access to the internet, the ability to get more information, and even a little bit more ease of execution, I think there's a lot more U.S. investors that are up here in Canada. But like I said, there is still a degree of information that's missing, and the emphasis is usually on the shiny object, the shiny, exciting company, rather than the company that's just out there doing a lot of hard work and making things happen. So I think it's likely to continue this mispricing, but I certainly over the last 25 years have noticed that it's gotten a little better. I mean, guys like Mike Schellinger that you mentioned, and even your interest in this podcast for Canadian companies, I think all this is starting to increase the awareness of some of this mispricing.
There's definitely something to be said when, Paul, I mean, just in what you guys do, you partnered up with a U.S. born millennial for small.
I know. Shocking. I know.
So, but and actually one follow up to that, because I'm really just curious, is it almost a self-fulfilling prophecy? I mean, at one point, are you guys nervous at all that maybe this was a question I actually had a little bit later, but it's kind of a good segue right now, is are you worried that with the amount of attention given to this sector, and I'll take some of the blame here, are you worried at all that maybe some of the new quality stories have already been exhausted? Brandon, I'll throw that to you. Sorry.
Yeah. I mean, I think you're always kind of worried about that, and it's a delicate balance of getting value-added investors into the ecosystem, and because ultimately, for a stock to go up, you have to have new buying interest. If you have the same group of shareholders, it's going to be hard to get share price movements, which is ultimately what you want as a shareholder. But you're right. I mean, you get to a point where everybody's talking about these companies. Everyone's doing really well. Even some of the less quality companies are seeing share price moves, and people are making money. And it kind of forms this virtuous cycle where more and more people come into the fold. And I think we've certainly seen that, but I tend to think that things move in cycles. So while we started to see that maybe a year and a half ago, all of a sudden the resource space started to come to life. Mm-hmm. And some gold stocks and even some of the oil and gas started to come back to life, and people immediately turned their attention to that and kind of lost focus on our space, which is the non-resource Canadian. So while it may feel like that at a certain point in time, it doesn't take a lot for investors to lose interest or to move on to something else. And I tend to think that even some of the U.S. guys that are looking at Canadian stocks, I mean, their preference would be to invest in U.S. So if more opportunities came in the U.S., I don't think it would take a lot for that kind of interest to flow out just as quickly as it has flown in recent times. Yeah. Paul, anything to add to that?
I was just going to say, Paul, you've been at this for 25 years. I mean, you've seen a cycle or two. What's your comment?
Yeah, no, exactly what Brandon said. It's cyclical. We've had other times where, with launches of companies, success stories, you get an influx of interest, and then it wanes again. And Brandon was dead on right about the resource sector. It seems when I say shiny object earlier, resource sector right now, whether it's lithium, whether it's uranium, whether it's gold, whether it's whatever, it sucks the interest over there, and all of a sudden we're left by ourselves again in this sector. So I'm not worried about it because I've seen it over and over again. The opportunities will always present themselves. The best opportunities will always be available to those that look for these things the most and the hardest. Mm-hmm. So I'm not worried about that at all.
Mm-hmm. So, Brandon, I wanted to come back to you real quick on this, because this is actually something that just came up recently in a conversation I had, and it has to do with because some U.S. investors see that there's a stumbling block when it comes to making an investment in Canadian microcaps. Because you are the U.S. born individual here, of the partnership. I'm just curious. Was it difficult for you to invest in Canadian microcap stocks?
Yeah, I would say it is and it isn't, depending on how you look at it. I mean, if you were going to do just public market, investing, the vast majority of Canadian stocks do have U.S. equivalents, OTC tickers, which through any discount brokerage, whether it's Scottrade, Fidelity, or even if you have a full service, is pretty easy to get executions on those stocks. So from that standpoint, there's really nothing preventing U.S. investors from investing in Canadian stocks. Now, some of the really obscure and early and unknown companies that we find, occasionally we'll come across a few that don't have the U.S. ticker, and then you have to be set up to trade in foreign currencies, which can be a bit of a hassle. And we always suggest to these companies that we end up speaking with management to make a U.S. listing available. So from that standpoint, there's really not a lot blocking you. Now, if you wanted to invest in some of the private companies, which is a component of what we do at Small Cap Discoveries, through private placements, direct financing, that can be a little bit more complicated and usually requires having a brokerage account in Canada. And so if that's desired, then that is certainly much more difficult than having just a brokerage account and investing directly on the public market. So I would say the answer depends on what type of investing that you want to do. Mm-hmm. But in general, it's a lot easier than I think it has been in the past. And I think you're starting to see a lot of U.S. investors invest in Canada. I mean, we estimate about half of our subscribers are U.S.-based, and so for that to be true, it can't be that difficult for them to invest in a lot of the companies that we follow.
Mm-hmm. Cool. And Paul, did you want to add anything to that? I mean, and were some of your clients, when you were a broker, were they U.S. clients that, you kind of had to walk them through exactly how to do it?
Well, one of the rules in Canada, it's very difficult for a Canadian broker to actually have U.S. clients. So that was another one of the sort of broken industry issues that I mentioned earlier. But I think a lot of the companies in the industry right now, a lot of the smaller companies are starting to recognize that they need to make it as easy as possible for U.S. investors to be able to participate. And like Brandon mentioned a little bit, we tend to try to push companies to bulk up their U.S. listing. So whether it's a pink sheet listing or an OTCQB or QX, something like that, usually, we'll either help them if they haven't already done it. But a lot of companies now are starting to recognize that's almost a requirement. Mm-hmm. Just to make it easier.
Mm-hmm. So, I want both of your opinions on this. Where do you guys see the Canadian microcap market going? You alluded a little bit to this, to the idea that, resources are kind of starting to make a comeback. But, overall, maybe over the next, let's say for 2017, where do you guys see it going? Paul, let's stay with you, and then Brandon follow up right after.
Sure. Well, I'm first off, I'm an eternal optimist, so I'm always expecting good things going forward. To be honest, I think we're finding it a little bit more challenging right now to find a lot of good deals. So it used to be that without too much effort, you're going to find a handful of companies that make it through our criteria. So and a lot of that has to do with valuation. So from that standpoint, we'll just wait until we find what we're really looking for. Otherwise, what I'm noticing is that, and again, this is probably cyclical and it comes in waves, but we're starting to see some better quality companies coming to market and getting listed up here in Canada. We've been fortunate that two of our wins have been companies that we were involved with from the private stage and helping them to go public. And when we see that, when you see that sort of success, it tends to bring more companies in. So we're pretty optimistic from that aspect. I think the Canadian market is reputationally, it's getting a little bit away from the resource sector, which I think in the long run is a good thing. And, again, with guys like Mike Schellinger and a lot of U.S. investors having easier access to Canadian markets, I think it's just going to embolden private companies to get listed, and hopefully that gives us more opportunities.
Mm-hmm. Brandon, what's your take?
Yeah, I mean, I would agree a lot with what Paul said. I mean, we don't do a whole lot of, market forecasting in terms of where do we think, stocks are going to go or where's the overall market going to go. We don't do a ton of that at Small Cap Discoveries. But what I would say is that I definitely see the legitimacy and kind of the investor opinion of the Canadian space continuing to increase as it has. And whether that's, through other bloggers coming up and your U.S. guys starting to cover Canadian companies, a lot of the different success stories where some folks down in the U.S. see how well these companies in Canada have done, and that, a lot of the companies in Canada feel that they don't just have to stay in a point where nobody knows them and they can't get access to capital. And, we've done a lot of work to try and identify those companies and where we can help out. And I think by continuing to do that, companies will start to learn that, the junior Canadian space is one where you can get listed, you can get capital, you can grow your business, and ultimately you can do well for your shareholders. And so I think 2016 showed a lot of those success stories that I think will fuel a lot more action in 2017. But as far as where the overall market's going, it's anybody's guess.
Mm-hmm. So another thing that I'm really excited about is that both of you will be speaking at the Planet MicroCap Showcase in Las Vegas, April 26th through 28th, 2017. Brandon, you will be on the first ever live Planet MicroCap podcast, which will be awesome. Very much looking forward to that. And Paul will be joining Maj Suedan and Brent Cook on the MicroCap newsletter panel. Pertaining specifically to the panel, Paul, that you will be speaking on, and this is a question for both of you. One thing I really wanted to know is why do you think MicroCap newsletters are really important to the MicroCap community?
I think it's information. I think the smaller investor right now is bombarded with all sorts of information that requires them to sift through it all and to make judgment calls on investments based on all kinds of information, whether it's good information, bad information. There's a lot of information out there. It used to be in the old days that it was the brokers or people with analysts and specific parts of the industry that provided that information, but because of the way the systems are working, more and more of these brokers can only really recommend larger companies, mutual funds, packaged products. So there's a real absence of access to good, solid information in the smaller and microcap community. So, the newsletters, I think, have taken the place of that sort of the place where you got information before. It behooves an investor to find some access to information that they can rely on and depend on. And I think, newsletters, especially ones that have proven successful, I think have really taken the place of a lot of the brokers and others that used to be sort of, used to own that information. Mm-hmm. So, it's a lot of work, but it's worth it in the long run if you can access the right kind of information and know how to act on it.
And Brandon, you alluded to this actually a little bit earlier. You were a private investor. You wanted to put your ideas out there to network. Do you see with having this newsletter that feeds right into your whole philosophy? I would say, wouldn't you agree?
Oh no, yeah, absolutely. I mean, looking at this question, I learned the value of microcap newsletters firsthand. I mean, it was only 5 years ago I was a novice investor. Started to understand the value, the edge that I could have in microcaps, but had absolutely no idea what I was doing and didn't know where to go for resources. And what I found is, a lot of the larger publications, whether it's Yahoo Finance, they're not doing anything in the microcap space. And then even Seeking Alpha, as I was getting more and more involved, they were starting to restrict company profiles that were under $100 million microcap or market cap. So you had a situation where there really wasn't a lot of information out there. And I think people find something refreshing about reading a blog where somebody is putting ideas out there. They're disclosing that they own the stock. They're really kind of putting themselves on the line, their own money, their reputation, versus, say an analyst report where they're getting fees from the company and, they're kind of just getting paid to write the research. For me, I found something a lot more engaging about, somebody like me, whether they're in the States or abroad or what have you, really putting themselves out there and coming up with new ideas. And so over time, my reading list became almost exclusively newsletters, blogs, and company filings. Mm-hmm. And I didn't really pay much attention to the mainstream media or, the headlines. And that's really where I made my biggest strides as an investor. And so having gone through that just a few years ago, when I linked up with Paul and we set out to do the newsletter, there was really no question in my mind that what we were doing was going to provide value to whether it's new people new to investing or experienced investors new to the Canadian space. There's really just a huge information void that newsletters and blogs, real people that are making real investments with their money, are starting to fill, where once, at one point in time, I think it was all run by, a lot of the research houses and the different brokerage firms.
Mm-hmm. So Okay, guys. Well, again, I'm really excited to have you guys in Vegas. It's going to be a lot of fun. And I hope to see everybody who's listening to this podcast there, to see them doing their thing on these panels. And so for our audience, where can they go and find more information about both of you and Small Cap Discoveries? Brandon or Paul, I assume either one of you know the answer to this question. So I'll leave. How about Paul? Paul hasn't. I'll give this one to you. All right.
Sure. All right. No problem. You can go to smallcapdiscoveries.com. That's our website, and you'll get a good example of a couple of our old reports. See how we write, and just our philosophy. And if anybody's got any questions, certainly they can email myself or Brandon, and we'd be happy to answer them.
Cool. All right. Well, again, thank you guys so much for joining me today, and have a great weekend. And I will see you both in Vegas very soon.
Looking forward to it. Thank you, Bobby.
Yeah. Thanks, Robert.
Thank you. Thank you all for tuning in to the Planet MicroCap Podcast, and thank you, Paul and Brandon, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@stocknewsnow.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of stocknewsnow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.